Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall Series. I'm Eric Auskerson, one of your hosts for today. We've got a great show. Hope you're all having a good summer. So look forward to covering today's material with you. We're going to be talking about, some current activities down in Washington, D.C. And we're also going to have a great strategic discussion with someone that many of you know, Michael Faulkner, a former Assistant Secretary of Treasury. Will be talking to us about, the banking market, where interest rates are going, and also an overall look at the economic outlook. So here's the overall agenda for today. We're also going to be closing out and having a session with Rumi Hayes, who's the chair of PCPS, and Lisa Simpson will be leading that session. But to kick things off, I'm going to bring Barry Melanson up. And Barry, it's great to see you. Great to be with you here on the Town Hall.
Great to be here, Eric. And we have a great list of guests. I look forward to being with them. And I'll echo the statement you just made. I hope everybody has a great rest of the summer.
So Barry, well, Congress they're on recess right now, so they're back in their districts. Some of them are having retreats, but when they come back to Washington D.C. In a week or so, they're going to have a lot to do to prevent a possible shutdown of the government. Yeah,
we've been talking about on previous town halls the likelihood, I would say, of a government shutdown. And you're correct. They're back in their districts. They'll be back after Labor Day. That just gives you really about 3 weeks of legislative time, and that's not necessarily 5 days a week, to really do something to avoid a shutdown by September 30th. One of the things that has happened in the last sort of week or so is that Speaker McCarthy, and talking with the Republican members of the House, and remember there's a very fine majority there for the Republicans, talked about a conversation he had with Senate Majority Leader Schumer that of a possibility what's called a continuing resolution. You might hear it called a CR, but it stands for continuing resolution, which is a funding of the government for a short period of time. And he said that he had communicated to Schumer that that a continuing resolution not to exceed a couple of months was the most that he would consider. Later, Schumer came out and said that he thought something that could go to December 31st was in order. And now, the reason for that being important is, of course, that averts, at least in the short term, if it's passed, a government shutdown. But it's really uncertain as to whether this would actually happen, because it depends on whether it's called a clean resolution or not. If it just sort of funds the government, you get sort of one mix of people. You actually would probably get some bipartisan support on that. But McCarthy would probably lose some Republican support in that, because some Republicans in the House would actually want to see, as part of even a 60-day continuing resolution, some funding changes and the like. So he would need some Democrats to pass it under that basis. And then, of course, what does that do to his own standing and things of that nature? So it becomes very, very political as to whether or not they can even pass that at this point, or whether they would go to a shutdown. Anybody who tells you they know what's going to happen on this, and probably including Speaker McCarthy and Leader Schumer, is just sort of guessing at this point. I think there's a high degree of uncertainty. As it relates to our issues, though, I think this sort of the tenuous notion of the potential of a continuing resolution, the stalemate that occurs with this, and the possible shutdown of government makes some of those tax issues we've been talking about probably less likely to get passed, that probably less likely to be part of that process. We've been sort of pointing that out now for several town halls. The 174 issue, the extension on the 1099K reporting period for, the incidental sales or the internet-based sales. It sort of gets wrapped up into some that are very strong advocates on reinstalling the SALT deductions. Of course, there's a lot of people opposed to that. Child credit. It's a very complicated set of facts, and the majorities being so narrow, it is unlikely. It's still possible, but it is unlikely that is something that's going to move through in a piece of legislation that's designed to fund the government for some period of time.
So, Barry, I mean, the likelihood of something happening with those different items is more likely towards the end of the year. And the shutdown here, the key date here is getting something done by September 30th. Last night we had the first debate. September 25th is the next debate. So there's going to, obviously, this is all going to be mixed into all of the election talk. A lot of pressure in the system.
Right. A lot of election, it's already the election season, and that sort of dominates a lot of the activity as well. You're correct. There's a possibility towards the end of the year. Of course, that doesn't help with the 174 issue, or at least would require amendments and the like. But I would say that is even more complicated because there's such a limited number of days by the end of the year. There's a lot of things in the hopper. And so you're really talking about a tax package getting through, even if it's a small tax package. And then the fighting over SALT deduction and the child credits. I think it's complicated, and anything that's very polarized, which everything is polarized in Washington right now, but anything polarized on funding the government probably even makes some of those things even less likely.
Well, Barry, let's move to a topic that we've been covering on the last couple of town halls, the beneficial ownership information rule. And we've got a call to action that we're going to be bringing to the town hall community.
Yes, we do, and it's a big one. We've been talking about the beneficial ownership rules, the lack of regulations that have come out of the regulatory functions and the regulatory processes that are there. FinCEN, a lot of uncertainty, huge volume in this process. Let's remember this is a proposal that affects small business. It's about reporting ownership of anyone greater than 25%, and maybe more importantly, any movement in that ownership in a really short period of time, 30 days. There's a lot of issues associated with who ought to be doing this. Some people in the profession see this as an opportunity of service, and some people have some grave concerns about it. We're going to be coming out with some further guidance on engagement letters through our insurance program in the near term. But for right now, the issue is, how does this get implemented? There is a piece of legislation pending that would delay the implementation date of this, and there's something 30+ million filings that will be required of small businesses. This is LLCs, things of that nature, that maybe a single owner LLC that your client has on their own 1040 return, et cetera. There is still there's a lot of uncertainty with the lack of the rules. We do know that FinCEN has all of its rulemaking has to be reviewed in the Office of Management and Budget, or the function of the Office of Management and Budget called OIRA. There is a rule there that we have learned of that just got put in place that would reduce for a new entity the time frame we hear from the 30 days as proposed originally to 90 days, but it doesn't change the time frame of the 30-day requirement when there's a change in ownership. So it fixes a little piece of the puzzle, but not the full piece. But the reality is that there's a lot of uncertainty. There's a piece of legislation which is on your screen. That legislation is called actually the Protecting Small Business Information Act of 2023. There is bipartisan support for this. There's bicameral. It's in the House and the Senate. And as they start to come back, we really want to get as many members of the House, members of the Senate to be supportive of this. And we're asking the town hall community here to download the toolkit that we have, which you can download it directly in the resources from this town hall. It'll also be sent out afterwards. That'll let you look at the talking points, find your member of Congress, send it to them directly, encouraging them to act on this. We really want to try to get more momentum to get this in place before September 15th. It'll continue beyond September 15th, but the more traction we get before September 15th, and the more attention it will get to actually potentially get through the system, or as another piece of legislation moves through the system to be put forward in that process. So this is very important. There's a lot of uncertainty. The rules have not been adopted. And what the law would say is that it doesn't become effective until after FinCEN actually adopts all the necessary rules. And there's 3 tranches of rules that are necessary. They've only begun working really on one of those. So it is a call to action. It's an opportunity to communicate to your members of Congress, to explain the hardship on small business that will be occurred here, the inadvertent compliance issues. Remember, this is about anti-money laundering. This is about the government's attempt, and it's not just the U.S. government's attempt, it's governments around the world to crack down on money laundering schemes and money laundering activities that are out there. These things have been highlighted, of course, with the Russia-Ukraine war, but it's happening in other places as well. And so that's the intent of the bill, but the practical application of the legislation, of course, is very complicated and will be very burdensome on small businesses.
Well, Barry, thanks for that overview. We will be sending out this information in the newsletter next week. You can download the Word document in the resources section of your toolbar. It's very straightforward, and it explains to you how to, follow up with your elected official to, request, to put your support behind this bill. Well, Barry, with that, we're going to bring up a Treasury official right now, a former Treasury official. We're not going to be talking FinCEN with you, but first off, Michael Faulkner, it's wonderful to have you with us. The town hall community knows you well. For those of you who were not with us in March or April of 2020, Michael Faulkner really was the lead at the Treasury Department in creating the PPP program. He was in the room where it happened. He put it together. And then he played a fantastic role with us in this private-public partnership over a year as we really helped, keep those small businesses functioning with that important lifeline. So, Michael, it's great to have you back with us again.
It's great to be with you, Eric. Glad to be with the town hall.
So, what we're going to kick things off with is Michael's been busy. You've been testifying. In front of Congress. You most recently testified in front of the Senate Banking Committee about the overall banking market, the banking system here in the United States. So we'd like to start the discussion on that. One thing I want to share with you is when Silicon Valley Bank had their crisis, that was a moment here with our town hall community, because the firms here, the 40,000 plus firms, work very closely with banks across the country and their clients. And there was also some concerns about the payment rails out there, because Silicon Valley Bank played a critical role there. But I look forward to kind of your thoughts related to the banking system in the United States and the comments you made in front of the senators.
Sure. So the hearing was primarily about the consolidation that we've seen in the banking industry. For those of you that don't monitor these things, in the 80s we had about 14,000 banks in the United States, and we're down to less than 5,000 now. And so the question is, why has there been so much consolidation? What is the impact of this on consumer choice, but also what is the larger impact on issues like safety and soundness and the resiliency of the financial system? And so my comments were largely driven by, there's two different forces at work here. If you think about what a bank essentially does, is it obtains information about potential borrowers. And the question is, how much of that information do you need local knowledge to obtain versus what academics have come to call hard information? So with the emergence of things like credit scores and payment histories for individual borrowers, perhaps there's a reduction in the amount of local information that's necessary for a good number of loans. And then at the same time, there's been so much technology advancements in the financial services space, at first with the advent of ATMs, but then you go into online banking platforms and some of the fintech lending that goes on. Then the kind of optimal size of a financial institution changes. And so what are the implications of that for the overall strength of the banking system? Is it a problem that, you've got more than half the deposits in our nation that are overseen by just 4 banks, right? So those were some of the issues that came up. And then you have all of this discussion in light of the recent bank failures. So Signature Bank, Silicon Valley Bank, why did those fail? And essentially the conversation came to, well, during the financial crisis, there was a huge inflow of funds into the banking sector. with all of the money that we doled out in the CARES Act, be it the PPP money, the economic impact payments, deposits at banks went up significantly, but not a lot of lending activity was going on. And so banks needed to put their money somewhere else. Folks at Silicon Valley Bank and a few others put it into long dated treasuries. And, for any of you that remember bond math from intro finance, large increases in interest rates mean large losses on the value of that bond portfolio. And in some cases, it wiped out the equity position of the banks.
Well, so you look at what happened there, was more regulation needed? What could have been done to prevent that? So
my sense is that bank supervisors, like many regulators, are always fighting the last war. And so because the financial crisis was largely based on failures on credit risk, that there were, loans made to borrowers who did not have the credit quality, too much of banking supervision these days is focused on credit risk, not on interest rate risk. And so even had Silicon Valley Bank undergone the type of stress tests that the largest banks were subject to, the stress test was built on credit risk. And Silicon Valley Bank, holding a bunch of treasuries, wasn't facing credit risk. So it would not have come up in the stress test. So it's not per se that they need more regulation. It's that we need the regulators to not be too narrowly focused on always fighting the last battle, and to think more kind of universally about sources of risk rather than being narrow on just kind of the last form of risk. So that's one issue. The second issue is, do we need to revisit capital requirements so that irrespective of what kind of shock takes place, there's two ways you could go about monitoring the banks. One is you could have lower capital requirements and then lots of supervision and have the supervisors try to keep you out of trouble. Or second, we just assume that the supervisors aren't going to find every source of risk and just make sure that the banking sector is more highly capitalized. That's kind of the trade-off that we discuss in academic circles is, might we have less reliance on supervisors and instead raise capital requirements for your largest institutions so that they have more absorption of any shocks that take place?
Well, we're going to move into interest rates in a minute, and Barry, if you have a question, jump in here. But just on, I know you've done some research. You look at, the U.S. banking market to the European banking market, and you talked about the four largest banks, but just the important role that these small and regional banks do related to, providing loans. And I know in your testimony you had some stats. So maybe talk a little bit about those stats and a little bit about, why the U.S. market potentially, drives a lot more entrepreneurialism.
Absolutely. So back in my days when I was running the Paycheck Protection Program, community and regional banks were there from day one. It took some of the larger financial institutions a little bit longer to jump in, and then the fintechs were much later. It really was the community banks that were at the forefront of partnering with us on the lender side to get the program up and running. And that's because your typical small and regional bank has about 13% of their lending portfolio going to small businesses, whereas the largest banks, it's closer to 6%. So they're twice as focused in terms of the allocation of their lending portfolio on serving small and medium enterprises in their communities. And so it's essential that we make sure that we maintain a robust system of small and regional banks that can provide for these borrowing needs of the innovative companies out there. A lot of economic growth is generated by small and medium enterprises. They employ about half the nation's employed workers. So ensuring that they continue to have access to capital to facilitate growth is essential. And that's why, as we think about implementing changes in banking regulation, we always want to make sure that it doesn't have too great of an impact on the small and regional banks who are ultimately operating a fundamentally different enterprise than the larger banks. And so that's why some of the work we did in the last administration to raise the levels at which some of the more stringent regulations were implemented was to very much recognize that the business model of a community bank or a regional bank is fundamentally different than an international bank.
Michael, just to follow up on that, because the small business issue is a very critical one. Virtually everyone listening on this town hall would be sensitive to that. And as you said, it supplies so much power to our economy, and it looks different in the United States than many other countries of the world. But you talked about the discussion even at the hearing in your opening comments about consumer choice and the necessity for the small banks. But this last segment that you just had is really, that's where the power in the economy comes with those small businesses. Do you think the Treasury Department, you think the Congress really gets that? And particularly when you talk about capital requirements, some differentiation, because the ability to lend in that space, there's a lot of frustration right now, I think, with the sort of the inability to borrow to do entrepreneurial businesses.
Yeah. I think the Congress very much gets it. That's one of the things that's highly bipartisan, is a recognition that Main Street is funded by community banks. Mm-hmm. So there's a very large distinction made between the national and international banks versus the community and regional banks, and understanding the very vital role they play in facilitating access to capital for Main Street. So I think that is recognized. Where you come into some tension is where you draw the line on where a bank goes from being governed by the rules for community banks versus governed by the rules for your systemically important financial institutions. And that's what I found a little bit disconcerting about the way that some of the bank failures were handled is, are they really systemically important such that we needed to extend deposit insurance to the uninsured depositors for all of the three banks that failed? And what does that mean for deposit insurance going forward? So I think this episode means that Congress does need to revisit deposit insurance eligibility. Maybe the solution isn't merely to just raise the amount that's guaranteed, but instead perhaps differentiate transaction accounts from interest-bearing savings accounts, because the problem is not so much that consumers have their savings wiped out. It's that the payroll account of the employer takes a hit. And so perhaps we need to revisit payroll accounts for businesses as having different deposit insurance coverage than private accounts that are interest bearing and receiving, savings rates.
It's payroll and also payables because of the supply chain aspect. It's both of those elements.
Right. So transaction accounts is
transactions. That's right.
Well, my one thing I think we'll do, we have a newsletter that follows the town hall, and it's August, and we've got over 8,500 people with us today. But I think we'll send your testimony, because I think you had some provocative statements. You even stated that maybe you should have not had the guarantee of all the deposits there at Silicon Valley Bank, and that could have helped correct the system a little bit. Moving on to interest rates, a lot of it, we talk about the interest rates, where they're going. So we'd love to hear from you. Today, I think mortgages hit a 20-year high at 7.23%. So what's happened, and where do you see them going? And we got a big meeting with the Fed this Friday.
Yeah. As your viewers know, we had the highest rate of inflation in 40 years, and it meant the most aggressive activity by the Fed in 40 years. Now, that said, I think the Fed started way too late. As the economy was reopened. So if you all recall, as soon as the pandemic hit, the Fed lowered interest rates by 150 basis points, took them to essentially zero overnight. As the economy started reopening, why a year and a half into the recovery were interest rates still at zero, right? If we're back down below 5% inflation, if the economy has gotten to economic output on par with where it was prior to the onset of the pandemic, then it seems like interest rate policy should have likewise returned much sooner to where it was prior to the pandemic. And in fact, in May of 2021, I wrote an op-ed in the Baltimore Sun that said, as the economy returns to normal, so must the Fed. Unfortunately, it wasn't until into March of 2022 that we started the Fed raising interest rates. And because they were so far behind, they've now had to try to get ahead of it. And we've now got interest rates higher than they've been in 20 years. Monetary policy operates with a lag. And so the market and economic actors still have not fully felt and responded to the higher interest rate environment, which is why even though inflation has not yet come back down to the Fed's target 2% interest rate, there's a whole bunch of implementation of monetary policies still to be felt. So I've called on the Fed to pause, that I think that they've raised rates enough. Couple that with the fact that they are pulling back on some of the monetary base. Also, we've seen reports from lending officers that lending standards have tightened in a post-SVB failure world. Couple that also with the recommencement of student loan payments is going to be a drag on the economy. So there's already some headwinds facing the economy. I don't know that the thing we need right now is for the Fed to raise rates even more. Now, if they do a quarter point, it's not a huge impact, but I think we're probably topped out at about where rates need to be.
Well, you also commented in our previous discussion just about the duration risk that the Fed actually has and what's happened there with the Fed balance sheet.
Well, that's the other piece, is that not only did SVB and Signature Bank take losses on their portfolio, but remember, during the pandemic, the Fed itself was buying long-term bonds. Mm-hmm. So the same losses that SVB and Signature Bank took on their bond portfolio, the Fed itself is taking. And so just to explain to everybody what that means, in a normal year, the Fed pays dividends to the Treasury to the tune of about $100 billion. And this year, they've paid a whole $500 million in dividends back to the federal government. So when you see that we're running a bigger budget deficit this year, yes, a lot of it is that spending is up on interest costs, but some of it also is that there's about $100 billion in missing receipts from the Fed that's normally there because they themselves took losses on buying long-term bonds during the pandemic and then rates coming up so fast.
Michael, just to jump in on that point, as I talk to our members around the country, I think that last point, the debt service cost of the American budget, if you will, the United States budget, which obviously with high interest rates is at extraordinarily high numbers and going higher because of the accumulation of deficit, right?
Correct.
That's a major sort of weight on the economy, as well as, future taxes and everything else that need to be done.
Yeah, think about a $32 trillion outstanding debt at a 1% interest rate, and then think about it at a 4% interest rate. Projections have us spending more on debt service by the end of this decade than on the Pentagon.
Wow. Well, let's pivot just to your economic outlook, where you see things are going. I mean, the job market, less and less talk now about a recession. What's your thinking?
Yeah, we're in a time of labor shortages. Most of my lifetime, we've had more people looking for jobs than were jobs available. And that's not the case, right? We have about 1.8, 1.9 job openings for every unemployed person. And that's why the unemployment rate is so low. And that's largely a function of we have an aging population. And so that's putting huge pressure not only on the United States budget, but around the world and among developed nations. So what that means is that jobs are plentiful and people are moving around in jobs. The challenge that we've got is that wages have not really kept up with inflation. And so the result is that we are anticipating that consumers are eventually going to have to pull back. Now, the question we've got, and we've seen that very much in the housing market recently. The question is, though, that there's a lot of spending that's been authorized by the government. And so how much will things like the CHIPS Act and the Inflation Reduction Act, the spending in those bills, offset some of the pullback in consumers such that, you maintain kind of a reasonable 1%, not reasonable, that you maintain moderate or small levels of growth. The other challenge, of course, that we have out there is what is the ongoing relationship with China? We saw that how geopolitical tensions with Russia and Ukraine impacted energy prices and food prices, because remember, Russia is not just a source of oil and gas, it's also a source of fertilizer. And so that had implications into the food chain. It would be orders of magnitude bigger impact if there were to be a geopolitical tension with China. There's some saber rattling going on there. So what does that what would a potential geopolitical conflict with China mean for economic growth? What does it mean? What kind of transition on supply chains would all of a sudden need to take place? And if that happens, then you're looking back at a very inflationary environment.
But
So,
also, Michael, the muted growth in China itself is also having ripple effects.
yeah, that is the other piece, is that you look at China largely built a lot of its growth in the last decade around real estate. They over-invested in some of their second-tier cities. They're struggling now to generate sufficient cash flows, both on sales of those properties as well as rental income, in order to pay off the debt that has been taken out. A number of the municipalities are in trouble in China. That meant that growth forecasts for China have come down significantly. And prior to the pandemic, a lot of global growth was coming out of China. And so if they're no longer the engine of growth in the world, that has repercussions for ourselves as well as our trading partners.
Well, Michael, fascinating discussion. I mean, the thing is, I have a lot of comments coming in. You know, some people are feeling that the unemployment numbers don't reflect what they're seeing in their local area, which is obviously true. We've got a very large country here. But maybe one final question, just on, you know, the U.S. dollar being the world reserve, the world currency, and just there's some questions coming in, and just like, you know, who are the holders of the U.S. debt?
Yeah. So I testified to the House Financial Services Committee in June on this topic. Essentially, there are three things that one needs to do to maintain status as the world's reserve currency. Number one is you need to have a technology and a regulatory environment such that we have the most advanced payment system in the world, because ultimately it is for purposes of making international payments that reserve banks determine which denominated securities to hold. Number two, you need to be good fiscal stewards, because if foreign reserve banks are going to hold claims to your future, then it has to be a strong, growth-oriented, responsible future that's not going to just have those securities see their value decimated by inflation. And then number three, you need to responsibly manage how you leverage your position as the world's reserve currency when it comes to things like sanctions and using the financial system to punish foreign actors. And so if the sanctions regime is abused in a way that you incentivize other countries to create an alternative, that has potential challenges. Now, in the short and intermediate run, we don't see that anybody per se is going to compete with us to provide the world's reserve currency, but that doesn't mean we take our eye off the ball of those three things.
Well, Michael, thank you. And it looks, even what's happening with China right now, it doesn't look like China is in the position to kind of move the U.S. out of that role. Would you, if you had to say who would be the other player out there, is there even another player that has the potential right now?
You know, when the European Union started, the thought was, and the Eurozone was created, the thought was that the euro could eventually come to replace it, but it so far hasn't. China, the problem, of course, is that nobody really believes their economic statistics, and the fact that they've got capital controls means that if people buy Chinese yuan denominated securities, they can't necessarily get the money out. So it's hard to see that there's anybody on the horizon. There's talk sometimes of like a BRICS coordinated, Brazil, Russia, India, China, right, type of basket, or like a petrodollar. The challenge you have there is, imagine for a moment you had a currency backed by oil, and then there were a geopolitical conflict. Would whoever's backing it, whoever is issuing it, would they suspend conversion? And if they suspend conversion, then it's no longer a petrodollar. So who is it that has the trust that even if there were a war, that they would still convert dollars or petrodollars into petroleum? And if you don't have anybody out there that can do it, it's hard to see who comes on board. But we should not abuse our status as the world's reserve currency and think that we're endowed to it. We need to continue to earn it. And that means managing those three things.
Excellent. Hey, that's a great summary, Barry. It's great having Michael Faulkner here with us today.
Appreciate the relationship, Michael, and also the great insights.
Thank you.
Thanks, guys, for having me. Always great to be with you.
Thank you. Okay, so that was a good economic class for our town hall audience, and now we're going to move on. Barry, you'll be back with us shortly, but we're going to bring Lisa Simpson up for some technical updates. Lisa, it's great to see you.
Thanks, Eric. Last time I was after Dr. Johnson. This time I'm after Michael Falkender.
Yeah.
You guys are not setting me up to succeed here, but thanks. Let's jump in and start with some technical updates. Unfortunately, we'll start with IRS news about providing disaster relief to the victims of the horrible fires in Hawaii. The disaster relief was announced in August 18th, and I think we've got some details on the next slide. So you'll see that they've given an extension for payments that were due after the dates of the fire until February 15. So we've given you a link to the announcement about the details of the relief for those victims. But I also wanted to call your attention to our Disaster Relief Resource Center. We know that there are many of you and many of your clients across the country who have been impacted by disasters over the last few years. So first, I want to touch on our advocacy efforts. Our legislative team continues to push for legislation that will make the disaster relief process more uniform. It'll give some permanency, and it'll make it more immediate. One of the recommendations that we have is that as soon as a state designates a disaster area, then the IRS could automatically extend IRS relief to that area. So just a way to streamline the process and take some of the uncertainty away at such a difficult time. We also have an AICPA benevolent fund that's been around for many years. It is available to AICPA members who are personally impacted, and not just a disaster, but who have some other type of need. Maybe it's a health issue or something like that. So we've given you a link that'll take you to that resource center. A lot of good information on casualty losses, disaster tax relief. I couldn't talk about disaster relief without talking about Jerry Schreiber, who we affectionately know as the Master of Disaster. The podcast link that's on the last bullet there is a really good refresher or introduction to a lot of the nuances behind disaster relief. So great resources there that our tax section has provided. And again, just want to make sure I mentioned our benevolent fund. So let's move on to something a little happier, and that is recent news from the National Taxpayer Advocate. She released a blog this week, Erin Collins. He released a blog this week that talks about some good developments in Tax Pro accounts. Our team's been advocating for a Tax Pro account as far back as 2015. The IRS actually launched it in 2021, but the functionality's been pretty limited up until this point. But now there are some new features, and you'll get a lot of the details of those new features in the blog. But if you look, it'll let you be much more efficient about looking at what active authorizations you have and managing those authorizations. So good things there, but I think the real highlight is what's on the horizon. Outlined in the strategic operating plan are some really good improvements to how the Tax Pro account works. And, again, we're pleased with seeing what's been done to date. We're pleased with the roadmap, and we'll continue to keep this on our radar. So if you're looking for some good news, take a look at that blog, and I think you'll be pleased with where the Tax Pro account is going. If you don't have a Tax Pro account, the blog gives you a link to sign up for that as well. Then I want to switch topics to our ongoing series around reimagining your tax practice. We've had a lot of conversations over the past few months about AI, and the next topic in this reimagining your tax practice series is around adding AI into your tax practice. As a reminder, these are free. There's no CPE, but you're going to get a lot of great information out of each and every one, and you can go back and look at the library if you've missed some of them. So just a quick reminder there. Then, if you were on the last town hall, we talked about an IRS announcement about how to the timing and the methodology for recognizing income related to digital asset and staking. So we now have, I want to tie into that a little bit with some updated resources around accounting and auditing for digital assets. So this is our an update to our digital asset practice aid. And this was released at the end of July. The topic sounds nuanced, but it's considerations of an entity's use of a service organization. Then when you get into details around when you would be looking for a SOC 1 report, but you're getting a SOC 2 report instead, it's all, very nuanced, but we've got a great blog that will kind of outline when to consider whether this practice aid will be of relevance to you. It outlines some of the challenges and points you to some things that you need to be thinking about as you're planning an engagement, as you're looking at risk assessment. Specifically, this new chapter is for where you've got a situation where an entity is using a service organization that might be impacting their internal controls over financial reporting. But again, you get a SOC 2 instead of a SOC 1. So as a reminder, we'll be having a more detailed digital assets update, tax, accounting, auditing later in the fall. But just wanted to get this on your radar because it's new. We also have a very robust library around accounting, around digital assets in total. So not just audit, not just accounting, but also tax resources. And I think we've got those listed for you on the next slide. I wanted to call your attention to a new Tax Section Odyssey podcast. Again, this podcast is free to anyone to listen to, and it gives you some good information on questions to ask clients if you're considering whether or not you want to take on their tax work, specifically if they're dealing in digital assets. So a lot there, including practice aids, glossaries, learning resources, and more. So I think that's it for our technical update. But next, I want to talk about, I want to introduce our special guest for this section, and she is Arume Hayes. Arume is a small firm practitioner in New York City. She is chair of PCPS Executive Committee, which is this practice management resource center for firms within the association. She's recognized as one of the 25 most powerful women in accounting in the last 2 years. She is an active member of Tax Twitter, incredibly involved in the New York State Society. I've decided, as I was thinking about how to introduce her, is that she's basically Roy Kent. She's here, she's there, she's everywhere, and I'm really glad that she's here with us today. So welcome, Arume. I thought we could start by just having you tell us a little bit about your practice.
Thank you, Lisa. It's so great to see you, and thank you for the invitation. So I have had my firm for about 6 years now. I have a team of 3, including myself. So I have 1 in-house staff accountant, 1 remote staff accountant. I work with a couple of consultants throughout the year, and about an average of 6 interns come through my practice. So just last week, I had 2 of my summer interns complete their cohort program.
It's always bittersweet, but hopefully you'll get them back.
Yes, and I do provide a variety of traditional CPA services. I provide, outsourced CPA services, payroll, advisory services, but no attestation services.
And that's pretty typical for firms of your size. So that makes sense. So you and I met because you volunteered to serve on the PCPS Executive Committee. And I was hoping that we could start the conversation by talking about our Transform Your Business Model project that the PCPS team is working on with the direction and guidance of our executive committee.
Absolutely. I am really excited about rolling out this program. The initiative that we're rolling out right now, we started a few months ago with the Transform Your Business Model. Now we are rolling out the strategy toolkit. And this is something that the executive team and the team at the AICPA put together, and Cassie Rushing of the Business Learning Institute created the program. It is great for firms of any size, but this is really beneficial to smaller firms because why? we lack the resources and the time to hire an outside facilitator to come into our firms to help us with this. Why is this important for you? It is going to help you as a small practitioner, as a small business person, own your future. So it's really important for us to have a clear vision of what our future is going to be. This strategy toolkit is going to help you decide, where do you want to take your firm? Where are you right now? Where do you want your firm to be in the future? And how are you going to get there? So it's a roadmap. We give you a toolkit, a 10-step process that you can do in your firm, whether it's inside the firm or you go outside on a 2-day retreat or something like that. Now, listen to this. The value of this strategy toolkit is about $10,000. We know that I myself as a small firm, I cannot afford to go hire a facilitator to come help me with this, my strategic vision. So this is why this is really important. Right now, it is free to all AICPA members. So I don't want you to wait until it goes behind the paywall before you download it and take advantage of it and utilize it. I have actually gone through the first steps myself, and it's a great toolkit. One of the things that Cassie Rushin said, because we always say that we're busy, running our firms and we don't have time for these other things. What happened to Blockbuster? They were busy running their business and they did not realize until they went out of business. So we do not want that to happen to you as a small firm. We want you to be proactive, own your future, take your future into your own hands, and start to plan that. So that's why you should take advantage of that toolkit right now. Download it. I'll talk about some other things that we're working on. We're all gearing up for tax season that's going to be coming up. We are going to be rolling out before the end of the year some additional resources for you to help you separate yourself from those difficult clients. We know we all have them, those E and F clients. This resource is going to help you with that. Additional resources that we're rolling out, it's going to be able to help you manage your team much better. So if you have a remote team or you have a hybrid team, those resources are going to be helpful. Some additional resources are going to help you build a better competitive compensation model for your firm so that you can retain staff. So those are just some of the things. And all of these offerings, we're going to be rolling things out one at a time, but we have some great things in the line for you.
Thanks, Romaine. It's a project that we're really excited and really passionate about. So we'll be talking more and more about it over the coming months. It's, I guess, a time for me to give a quick plug for PCPS. PCPS is very reasonably priced, and what we do is we pool the dues dollars for our member firms and then hire consultants like Cassie Rushing to develop these toolkits that we can then give back to you as a PCPS member benefit. So we'll give you some information in the follow-up newsletter about how to join and what some of the other benefits are. So Arime, you're a small firm practitioner. You got engaged with the association just a couple of years ago. Mm-hmm. So what have you learned about how we support small firms, or what are some of the favorite resources that you've seen us develop that maybe you didn't know about before?
Yeah, so some of the resources, definitely this town hall is a great resource for small members. I am an avid listener and watcher of this town hall, but the podcasts are available to members. One of the discussions that came out, I was 2 weeks ago, it's almost less than 2 weeks ago, I was in Denver for the Tax Twitter, shout out to Tax Twitter, the Tax Twitter retreat. And some of the discussions came up that the AICPA sometimes does not do enough for these small practitioners, for small members. And I beg to differ. I am sitting here, I have access to this platform right now. If the AICPA did not care about small firm practitioners, I would not have been invited to this platform to share with you all what's going on. So really, what it requires is for you to become involved, more engaged in what AICPA has to offer. So that is being involved, attending, if you're a member of a committee, attending meetings, downloading the tools and the resources that we have on the website. I think that the PCPS section is one of the most underutilized sections of the AICPA. Like Lisa said, the fee as a single CPA firm owner, the membership fee is $50. If you have up to, I believe it's about 17 CPAs at your firm, the top dollars that you would pay for that is $850. We have resources, we have engagement letters, checklists, we have, exit strategies, a lot of tools that are available, but these things are not going to come out to you if you're not going out there to look for them. So those are some of the things I've learned, that the AICPA definitely supports, small practitioners.
Thank you. I'll give you the $5 for that plug next time I see you. Quickly, let's move on, because I know there are a couple of things that are really important to you that I want to make sure that we talk about. One is volunteering, and then two is what you're doing by teaching in the college classroom. So let's quickly hit volunteering, and then
Okay.
I'll let you just lead on into your experiences in the classroom.
Yeah, absolutely. I think volunteering is a great opportunity for people to get involved. I enjoy it. You can increase your professional development, personal development, your leadership skills. I got to start to develop my leadership skills through the New York State Society of CPAs when I was in a committee, the Financial Accounting Standards Committee, and the chair tasked me to chair a task force to respond to a FASB exposure draft. And I wasn't sure I could do it because I had all this other, I felt more experienced CPAs in the committee, but they said I could do it, and I believed them. And with my other task force members, we were able to do this. That led me to other committees within the state society, and then to become president of my chapter, and then also to the statewide board. And after that, I felt comfortable, and I branched out to the AICPA. Doing that, this has expanded my network. It gives you a voice, it gives you a seat at the table. It allows you to also influence the agenda. You can advocate as a member. If you're a volunteer member, you can advocate for your position, for the profession. So I believe the AICPA has over 200 sections. You can volunteer to be in a committee, in a task force, in an expert panel, and applications right now are open through October 1st. I would encourage you, if you are not yet involved, please get involved. Do not do it. The one thing that I say to folks, don't do it to pad up your resume. You might get a momentary spike if you do that, get a momentary reward out of it, but you have to love the profession and love to give back. And if you do that, I think you will get, sometimes you actually get some business development out of it. So in reference to
So
teaching,
quickly, let's talk about teaching.
Yeah, teaching, I love that. I love teaching. It's a great way. And I think that is the best way that you can represent the profession in the classroom. We're always talking about, we have an issue with the pipeline. What better way for you to get the young folks interested in the accounting profession than for us to have more practitioners in the classroom? So sometimes I talk about my teaching on Tax Twitter, and I've had a couple folks reach out to me to inquire about it. And recently someone just decided that they were going to go on that PhD track so that they can also start to teach. And I just think it's very rewarding. So if you enjoy doing it, please go ahead and sign up.
And I've met several practitioners over the years who do that teaching, and they talk about just what a great rewarding experience it is, and how fun it is to be around people who are new to the accounting learning track, and how exciting it can be. So
Absolutely.
Thank you for all of your efforts.
Absolutely, Lisa. And before let me say one thing, I want to say thank you as well. It's rewarding, it's great. I want to say thank you for coming into my classroom over the spring semester. Lisa was a guest speaker in my classroom, and the students loved what you had to say. So that's why I think that practitioners are a great ambassador for our profession. Thank you.
So I think it's time to bring Eric and Barry back in, and we'll go into open forum. As we get started on that, I get a note that there are some questions about how to find that PCPS strategy toolkit. We'll send out a link in the newsletter next week, but also if you downloaded the slides today, you should have a link as well. Or you can go to the site and go to PCPS and look for transforming your business model. So much more to come on that one.
Well, Lisa, roommate, that was fantastic. Great session. Lots of positive comments. You got a lot of fans out there appreciating you being on today's town hall with us, and thanks for being in the studio. Lots of questions coming in, Lisa and Barry. Barry, the discussion with Michael Faulkner was fascinating. Just a lot of there's a lot of complexity out there, and one thing that I was talking to Michael Faulkner earlier on is just the increasing role that firms are playing related to their small business financing needs, and it's in the fintech relationship with these regional and small banks, and it's just continuing to evolve. I know that's something that you talk to firms about as well. I think this is something that's going to continue to be an important part of the overall dialogue between the firm and their client. And it's really not a competition type of element. It's the and story. It's the and story of the firm bringing their help and getting some of that information in, maybe through a fintech player or directly to the bank.
That's right, Eric. It sort of builds on Arume's points, and Arume, it was good to be with you in the town hall. If you go back, a lot of things that happen in history circle back. I think small firms in the profession in the 80s, certainly 70s and 80s, were very much involved in that sort of banking relationship for their small business entrepreneurial clients. That sort of phased away, in some fashion, in the late 1990s and the early 2000s, a different environment that was present. And it's sort of coming back, Eric, to your point. And it's through different relationships, technology-based like fintech, et cetera. And you're right, we did have a conversation prior to this town hall with Michael on that. And it goes to this choice point where you have less banks, less community banks, and how the regulation versus the practical solutions plays out. I think we'll see that trend continue for the next several years. And then, of course, regulation will come into that place as well.
Well said. So, Lisa, is there anything that you want to comment on before we go through our final slides here?
No, I can't see the Q&A, so I'll rely on you.
Okay. Well, Arumi, thank you again. Look
Absolutely.
forward to having you join us on a future town hall.
Thank you, Eric. Thanks for having me.
Thank you. So with that, in summary, we've got plenty that we covered today. We encourage you to take advantage of these slides inside your firm and with your clients or your employees. Right before we started today's town hall, we shared something on .cpa. More and more firms are thinking about their digital brand. We've put together a couple of webcasts and blogs and a white paper on just how you can think about positioning yourself digitally. I know that's something that Arumi does a lot as well. So coming up, the next town hall, Thursday, September 7th. Lisa, you and I will not be there, but we've got a fantastic team. We're gonna have Ron Baker, and we're gonna have a discussion on some tax topics, and Mark Peterson will be with us from an advocacy standpoint, as well as Michael Cerami hosting the overall program. So Barry, it's great having you with us today. Lisa, great having you with us. Barry, any final comments, summer comments for our town hall community?
I just want to reinforce, be active in the toolkit that we've given you on the FinCEN issue. It's pretty user-friendly to be able to use it, to make contact with your members of Congress and really have your voice heard in that process. We need that bipartisan support. This is one of those topics that can be bipartisan, bicameral, and have a shot to find a vehicle that's moving through the Congress to become a reality.
Lisa?
I'm going to be on vacation next time. Highly encourage you guys to be using your PTO as much as you can. But I'm really excited that April Walker and Dan Choden are going to be on to talk about ERC, because we continue to get lots of questions about how practitioners are handling certain things. So I think it'll be a really helpful conversation.
Thank you. Well, hope all of you are well for the remainder of August, and we look forward to seeing you in September. That's all for now.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.